Hello and welcome to our market alert video for today, which is December 6, 2024. I hope that this video finds you healthy, wealthy, and wise. I am Ken Murray, easy for me to say. I'm the founder and CEO of Retirement Planners of America, and thank you for watching this video. Thank you for following us. We have a lot to talk about, but this week I want to kind of encapsulate it into a game. We're going to play a 3D chess game when it comes to predicting what's going to happen next. I'm going to bring you into and make it interactive with how we go about looking at our fearless forecast each year. And as you guys may know who've been following us for many years, we always say that if you don't listen to our fearless forecast, you do it at your own peril, because we have been, as I see it, remarkably accurate. And in fact, this year pretty much nailed it. And so I want to go into that with you. Before I start on that, though, I want to tell you that a lot of you have asked about my knee replacement surgery. Yes, I'm still sequestered. My surgeon will not let me leave the house until a month has gone by after the surgery. So I got about another week to go. And he's got me walking 10 minutes every hour, 9 times a day. That's 90 minutes of walking. And I did the math on that. It's 4 miles. I'm walking 4 miles a day. I've never walked that much. So anyhow, let's talk about 3D chess. Okay, so we're going to play 3D chess, and we're going to talk about how do we go about predicting, what's going to happen next. And I'm going to ask you to tell me what you think. Okay, so you can use comments to tell us what you think. So going forward, let me tell you why this is 3D chess. So we've got the prospect, I think probably the certainty of tariffs, right? Donald Trump has said that he's going to use tariffs to help our manufacturing base, to bring back a lot of money to the United States, investment to the U.S., and also as a weapon against our I'll say our enemies and our foes. We have inflation. Is it going to come down? Is it going back up again? We have DOGE, right? This is new. Right, that's Elon and Vivek, and they're going to find all these ways, presumably, to reduce the spending that the government is making. And so we have to throw that into the thing. We have the jobs numbers, which we got this morning, so we got to throw that into the picture. And then we have, interest rates. What's the Fed going to do with interest rates? So are they going to raise interest rates, lower interest rates? What's going to happen with that? And then, if that wasn't enough, then you have to kind of look at historical context. Because if you look at historical context, as we've said many times on our videos, we get a correction on average twice a year, meaning a drop in the market of 10% or more, but not 20%, twice a year. And we haven't had that in almost a year. So, and then, of course, the big one, bear markets, which is a drop of 20% or more. And we average one of those every 3 years. And guess what? Next year, it'll be the 4th year. So you wrap that all together. And then what do you do with that? Oh, and there's one more item, which we actually think is the most important item, and that is confidence. Are people feeling confident? Because despite all the bad news that may be out there, if people are feeling confidence is the magic elixir. And I'm a tennis player, and as you know, in athletics, confidence is huge. If you have confidence, you can find a way to win. The moment you lose that confidence, chances are you're going to lose. And so that's also a very important thing. And then, there's one other thing that that we always use, and that is, you may remember Groucho Marx. He said that if a country club would have me as a member, I don't want to be a member of that club. So any club that would have me as a member, I don't want to be a member of. So we always look at the consensus. What does everybody think is going to happen? And that's our sanity check, because if what we think is what everybody else thinks is going to happen, then chances are we're going to be wrong. And in fact, that's what happened this year. When we were looking at it, we thought there was a good opportunity for the Fed to lower interest rates many times. But since that was the consensus, it caused us to look back at our fearless forecast and say, okay, well, if everybody thinks that, it's probably wrong. How could it go wrong? And that's why we changed it to say that no, interest rates would not start going down until the second half of 2024, which is exactly what happened. So we have all of our inputs. And like I said, there's a 1, 2, 3, 4, 5, 6, 7, 8, 9 different inputs into our 3D chess picture. So let's look at tariffs. So first of all, when it comes to tariffs, our view is that for the most part, they won't be long-lived. For example, let's say that Mexico decides they are not going to cooperate with Donald Trump on immigration. So he slaps a 25% tariff on them. It's not going to be long before they're going to say, okay, uncle, and the tariffs will be removed. So many of these tariffs are essentially negotiating weapons, if you will. And so for the most part, they won't be long-lasting in our view. So we don't, even though there's a lot of talk that tariffs are going to be inflationary, and if you put tariffs on inflation, less consumption in our country, that's going to dampen growth. As we described in the previous video, we don't think that that's going to be the case on that one. Okay, so we're going against consensus on that. You have inflation. Well, as you guys know, we think that inflation is going to go up through the end of this year, but come down in the first half of next year. And so if you look beyond just the end of this year and the next 3 months, you look into 6 months out into the future, our view is inflation is going to come down. So from that standpoint, the next thing we look at is interest rates. And from that standpoint, we think the Fed is going to be continuing on the trend of lowering interest rates. So now we look at jobs. What's going on with jobs? Jobs seem to be holding pretty well despite inflation and despite all the concerns that people have that, jobs are going to fall off a cliff. Hasn't happened. Seems to be the job market seems to be resilient, and we think that's going to continue. So now we go to, so we've covered all those. The big one, though, in our view, is the consensus and confidence. President Trump's election seems to have brought all kinds of confidence into investors. We've seen the market reach new all-time highs, and that's really where we want to keep our eye on. How confident are people in the policies that the Trump administration is going to bring? And right now, investors seem to find that that's a positive outlook. And then the other two things are important because it's kind of a weird thing how the historical averages seem to hold, even though you'd think, well, how can it be, that corrections come twice a year on average and bear markets come every 3 years. Well, if you look at that, you can say, okay, every 3 years we're going to have a bear market. It's not hard and fast, but you have to incorporate that into your thinking. And so given how far up and how fast the market has run, we think it's a very high likelihood that we could get a correction, meaning a drop in the market of 10 to 20% here in the next 3 months. So you bundle that all up, and that's how we think about in terms of coming up with our fearless forecast. So I'm not going to tell you what the fearless forecast is because we do that in January, but I want to kind of give you the source material so that you can kind of think about it and do some 3D chess in your own head, and maybe you can tell us what you think next year is going to look like, and we'll see if it matches up with our fearless forecast. Between now and the year end, though, it doesn't look like there's anything out there that could cause the apple cart to be upset. And so we think the Fed will lower interest rates here next week or on the 18th. And so because of that, we think things are going to continue as they are. We might see a few more all-time highs, and bonds should relatively hold their own through the end of this year. So that's our fearless forecast or summary, how we go about calculating it, and hopefully it gives you something to think about. So our firm, we work primarily with people who are over 50, who are retired or retiring soon. Our goal is to create as many SCWPS as we possibly can. We want, which if you don't know what that is, that's an acronym for Second Childhood Without Parental Supervision. When our clients retire, we call them a SCWPS, and we want to get out of here, go play, have fun, enjoy your second childhood, and don't bother us. Let us worry about all this stuff for you so that you don't have to. And, we also have a strategy we call Invest and Protect, because despite our rosy view of the next few months, it's always possible that something we did not expect happens. And we want to always have a strategy to address that. And of course, you guys know, if you followed us for these many years, that in 2008, we were out for the entire year. Our strategy said to sell. In the year of the pandemic, we sold the day before the pandemic was announced. We believe that growth is important, but protecting your principal is even more important. If you're going to retire, you need your money to be there for you for the rest of your life. You can't go losing mass quantities and expect to support the lifestyle that you want. So check us out on our website. Let's see your comments, see what you think, and we'll talk soon.